Trading floors are at their quietest right at 8:29 in the morning. It's the final moment of breath before the day's first economic data release hits the wires. Most days, the market focuses on consumer prices. But on this morning, the producer price index, the measure of wholesale inflation, became the primary driver of market volume. This chart shows the scale of the surprise. Investors expected wholesale prices to rise 0.3% for April. The actual number came in at 1%, more than tripling the forecast. Looking at the year-over-year data, the trend line shows a similar spike. Core PPI hit 5.2%, significantly higher than previous reports, and well above what analysts anticipated. Higher wholesale costs often act as a leading indicator for consumer inflation. This immediate threat of rising prices triggered a rapid sell-off in the government bond market. Within seconds, the hot inflation readings set off an algorithmic chain reaction. What started as a data release quickly turned into a coordinated move toward higher yields across the financial sector. The yield on the 10-year Treasury adjusted instantly. It climbed 3 basis points to 4.483, a sudden break from the morning's trading range that signaled a shift in market sentiment. With the benchmark for global lending shifting so rapidly, the focus turned to the housing market. Many wondered if mortgage rates would follow Treasuries into a similar decline. Because the 10-year Treasury serves as the floor for most long-term lending, a sharp move here usually implies that higher costs for everyday borrowers are inevitable. To find the actual impact on home loans, we have to look past the Treasury sell-off and analyze the behavior of mortgage-backed securities. This comparison reveals a significant discrepancy. While Treasury prices fell, mortgage-backed securities held their ground, dropping only 2 ticks, a negligible 0.06. This represents a decoupling of two assets that usually move in tandem. Despite the pressure from the PPI report, mortgage bonds refuse to follow the Treasury market lower. This resilience suggests that institutional traders were looking past the headline inflation number. They were responding to a specific set of details found deeper within the report. Professional investors rarely take a headline number at face value. Instead, they strip the PPI down into dozens of smaller subcomponents to see what is actually driving the change. Analysts focus on a specific cluster of data points within the PPI. These feed directly into the Federal Reserve's preferred inflation metric, the PCE. The fine print reveals why the market didn't panic. While total PPI was high, these PCE-linked categories actually softened. Because the Federal Reserve prioritizes these specific metrics when setting interest rate policy, their relative weakness provided the support needed to keep mortgage bonds stable. By analyzing the micro components instead of the macro headline, traders identified a level of stability that wasn't apparent in the initial 8:30 data drop. The question for homebuyers is how this complex institutional trading translated into actual interest rates. In the end, mortgage rates remained steady. The 30-year fixed rate sat at 6.56%, while the 15-year fixed ended the session at 6.04%. This outcome highlights the importance of looking at the data that drives policy rather than the noise of a single morning's headline. The day's trading shows that mortgage markets are driven by specific underlying components. Even when a headline suggests a move toward higher rates, the details in the fine print can tell a much more stable story.